What's up, everyone? This is Chris. I have a really special treat for you guys today. So some of you may know, but earlier last year, I had teamed up with my good friends, Jacob Manishevitz from Safebridge Financial and Anya Ettinger from Bosley Real Estate to have a first-time homebuyers crash course presentation. Now, we hosted it thanks to Anya and her brokerage at Bosley, where we basically had people attend, and we went over all the different kind of stages that first-time homebuyers need to consider and go over when they're purchasing a property here in Ontario for the very first time. So I've been lucky enough to have that presentation recorded, and I wanted to bring that to you guys as some more information so that you guys can be better prepared for your next real estate transaction. Now, it is a long video. Feel free to skip ahead if you have any questions. By no means is this a complete overview of what to expect, but it does kind of give some context and some reassurance into the whole home buying process, and maybe will help you answer some questions that you may be having that aren't answered in the videos that I have already. So hope you enjoy.
So thank you again for coming out. We're going to do our best to pack the presentation full of value. We've got a lot of great information for you. We're going to have some Q&A periods throughout the presentation as well to kind of break it up, keep it interactive. And so, of course, if you have any questions, feel free to raise your hand and we'll address as many of them as we can. I think between the three of us, we could probably answer most of the questions that you might have about purchasing real estate as a first-time buyer. We're going to do a quick intro about ourselves. Chris, if you want to hit the next slide.
Sure, of course.
And we're going to tell you just a little bit about ourselves, why, what our experiences were like as buyers as well, and then we'll get on with the presentation. So first we have Chris.
Hi guys, my name is Chris. I'm a real estate lawyer based here in Toronto. I've been practicing in real estate law for approximately 6 years now, and I help a lot of first-time home buyers, young professionals that are looking to purchase or sell or refinance. And in terms of a little bit of personal information, I actually recently bought my own place about a month ago, and it was a hard loft in downtown. So a lot of the information that I have in terms of being in the shoes of a first-time home buyer too are hopefully going to be passed on in this presentation so that you guys get a little bit more intimate information outside of just the legal side of things. Yeah.
Hi, I'm Anya. I am a realtor. This is where I work. I'm pretty much based out of Toronto. I try to focus on the actual city. I don't go out into the suburbs as much, but depends on the case. I bought my first house in November 2020, and I was also relatively new in real estate. I had done quite a few leases, but I hadn't gotten into working with buyers a lot yet. And I learned a lot with that experience. There were a lot of mistakes that were made, a lot of things that were overlooked. So I'm hoping to kind of share some of the places that I felt I went wrong in my own search. And hopefully that'll help you avoid making the same mistakes in the future. So yeah.
Awesome, and my name is Jacob. I'm the mortgage broker here today. I work with Safebridge Financial Group. I bought a freehold property in Durham region just coming up on a year ago now. And I'll tell you that I didn't really understand the client experience from the mortgage perspective until I went through it myself. And I always tell my clients everything's gonna be okay, we'll work through it. If there's any last minute hiccups, it's not gonna be a problem. But believe me, I was on the phone with the lender up until the very last hour before they wired the funds to the lawyer to help me close. So I know it can be a stressful experience, and I'm here to help you, through each step of the way. And that's kind of the perspective that we have here, and we're gonna bring a lot of value that way. So the seminar structure today, we've tried to divide it into 3 parts for you just to make it as clear as possible. We're going to talk about the pre-search, so everything you have to do and think about and get ready for before you even go looking for a property. We're going to talk about during your search, so what to look out for while you're doing that. That's obviously going to be Anya's area of expertise. And then we'll talk about closing day and beyond, because there's a lot of confusion as to how the timeline works, what happens as you come up to closing day. And so we're going to work through each of those. We're going to give you the mortgage, the legal, and the realtor perspective as well. In between each part, we'll do a quick Q&A as well. So if you have any questions that come up during that part, feel free to pipe up once we do finish that section. But we'll get started here. And so we'll talk about the pre-search, and we'll have Anya kick it off.
Okay, I wanted to start with just some frequently asked questions, these are like the first few things that someone will ask me when I get on a buyer consultation call. First one is how long the process will usually take. Totally depends on the person. I think my quickest turnaround was I had a phone call with the buyer on Saturday. We went to see properties on Monday, and they had an accepted offer on Tuesday. So 4 days was my fastest turnaround. My longest, I had clients that closed last year that I worked with for 1 week short of a year, and I have a client I'm working with now who's been working with me for about 14 months. So it really depends on it really depends on how quickly you actually find what you like, how particular you are, the inventory for what you're looking for. Maybe you're looking for a really particular kind of loft that doesn't come up often. It can take a longer time. Maybe you're looking for just a 1-bed plus den condo and there's hundreds of them, you know, over the course of a month. Really depends on what you're looking for. So that's the first one. Second is the difference between a buyer and a seller's market. This is pretty much contingent on how many people are actively looking to buy and how much inventory there is. So over the course of the pandemic, we were in a strong seller's market. There was a ton of buyers, very little inventory, which led to bidding wars. I'm sure all of you have heard stories of people competing against 5, 10, 15 people and just literally spending as much as you have to get the property and losing time and time again. We've now moved into more of a buyer's market, which is where there is more inventory than there are buyers. So buyers have a lot more leverage. You can get away with having conditions in your offer or just really asking for things that you couldn't ask for in a seller's market. In short, buyer's market, good if you're a buyer. Seller's market, good if you're a seller. And lastly is, how do you know what you can afford? This is where I pass things off to Jacob. I'll connect you with a mortgage broker if you haven't already spoken to someone, and they'll pre-qualify you, give you an idea of your budget, or do a hard pre-approval. Okay, so these are the key steps. First, you want to talk to a mortgage broker. I usually don't suggest getting started with your search until you've actually spoken to a mortgage broker, because I've dealt with so many people that have decided, okay, my budget's $800,000, but then they find out that their budget's only $600,000, or they find out their budget was actually $1 million. So you never really know. The online calculators are only so accurate. It's always best to talk to a mortgage broker and know the details before you get started, just so you can set your expectations. You also want to choose a realtor. Just because I'm talking doesn't mean that you should or need to work with me. It's always best to interview a couple of people and see who you find is a good fit. You might be working with them for upwards of a year and you want to actually feel comfortable with the person you're working with, and also just someone that knows what you're looking for. If you're dealing with someone that usually only sells condos but you want to buy a house, or someone that only works in Pickering but you want to buy in Mississauga, you want to find someone that is well suited to what you're actually looking for. Also, setting expectations, figure out what you absolutely need to have, what you absolutely don't want. Maybe being near a train track is a deal breaker, or being across from a school is a deal breaker. Lots of things that you need to think about before you get started. If you go in with too broad of a criteria, it's really overwhelming. There's far too many listings to get through, and it's really hard to figure out what you actually like and don't like. And yeah, I mean, this is kind of just an overview. I'm not going to talk too much about the other things until we move forward, but okay, big question, house or condo? If you have a budget that allows for a house or a condo, I mean, usually they are contingent on your budget. If you are not going over $1 million, you're usually confined to a condo, but generally speaking, houses will require a lot more of your own maintenance. Things break, furnaces break, water heaters break. There's a lot that you need to budget for ahead of time. However, you own the land that your house sits on. So if you want to build a shed in your backyard, if you want to, you can garden however you want, provided you comply with bylaws, but there's a lot more freedom to what you can do with your own property. Whereas if you go with a condo, you're confined to the bylaws of the condo corporation. So certain things you can't put on your balcony. Maybe you can't have a barbecue on your balcony. Maybe you can't have a dog. There's a lot of stricter rules that go in with condos. Other thing, condos are often smaller than houses, and you would pay towards monthly condo fees. It is a larger monthly overhead expense, but keep in mind that does go towards the maintenance of things like the HVAC in the building. So where in a house you might need to dish out 10 grand because your roof is leaking or your furnace broke, in a condo usually all of that will be covered by your condo fees. So it's almost like you're putting money into a fund for future repairs later. You can go to the next slide. These are some of the associated costs. A lot of these will be covered throughout the presentation, but just some key ones that you should expect during the process and at the end. Legal fees, Chris will talk about what to expect with that. Disbursements, adjustments, that all falls in with what's called your statement of adjustments, and yeah, Chris is going to go through that. You might need to pay HST on your default insurance for your mortgage. Survey is mainly if you're looking at houses, not as common in Toronto to do a survey, but just something to keep in mind. And yeah, biggest thing, home inspection, probably about $500. If you're seeing a lot of houses, you might end up doing a lot of home inspections. The hope is that you only need to do one. But that is something that you would pay yourself as the buyer. And then the last thing are moving costs. Totally depend on how far you're moving and the amount of stuff that you have. All right, Jacob's turn.
Awesome, I'll take over from here. There's going to be a lot of information here about the mortgage stuff, just because at this part in the process, before you even go looking for a property, this is really where I come in and help you establish your budget. We talk about getting a pre-approval done. We talk about collecting documentation, and really all of the most important things on my end are done right at the beginning. So there's going to be a ton of information here, and like I said, we'll do a Q&A at the end of this part if you have more specific questions about it. And we're also going to stick around afterwards if you want to talk one-on-one about your particular situation. It's no problem. But basically, there are 3 pillars of qualification when it comes to mortgages. Well, we have income, we have down payment, we have credit. These are what lenders look at when they're qualifying you for your mortgage, essentially. Under income, they'll look at the type of income, they'll look at the length of your employment, and they'll look at debt servicing, which is a term that we'll dissect in a little bit. Under your down payment, we're going to talk about down payment requirements, sources of down payment as well, and minimum down payments, because there's definitely a lot of confusion about that. And lastly, we'll touch on credit as well, what makes good credit, different types of credit that you should be using in order to be a credit-worthy borrower and look better in the lender's eyes. Next slide. Okay, so the most important thing essentially is income. Income is going to determine the amount of a mortgage that you're eligible to borrow. The combined household income, if you're more than one borrower, your single income, whatever it is, that's what the lender's going to look at to determine exactly how much of a mortgage you can afford. They're going to look at your type of income. So we have people who are salaried, we have people who work on an hourly basis, we have people who are self-employed, we have people on a contract. There's different types of income are qualified differently from the lender's perspective, and of course it's my job to help kind of navigate those differences. They'll look at your length of employment. So there's a lot of confusion around that. Some people think, oh, you have to be employed for 2 years in order to be qualified at your income, etc. The truth is, if you're a salaried employee and you're past your probationary period, you can use your current salary to qualify. Even if you're within your probationary period, sometimes we can get exceptions to be able to use your income as well. Length of employment is more important when you are self-employed. So if you own your own business, then they like to see a 2-year history of consistent earnings in that respect. And debt servicing. So debt servicing is essentially the ratio of your income that goes towards paying for all of your debts. And I think the next slide is going to talk a little bit more about debt servicing. Yeah, perfect. So your debt servicing, the calculation they use is basically all of your housing costs. So that's going to be your mortgage payment, your property tax payment, and half of your condo fees is what the lender uses to qualify if you're purchasing a condo property. And they divide that by your gross monthly income, so your monthly income before tax. And whatever that ratio works out to be is how they qualify you for the mortgage. Technically, this is your GDS, or gross debt servicing, and it has to be less than 39% of your gross monthly income going towards these carrying costs, including your mortgage payment, property tax, and half your condo fees. Next one, Chris. Perfect. Down payment. So your down payment is going to be subject to strict anti-money laundering guidelines. That means I'm going to ask for a lot of documentation, and it's just part of the process. So it's not me being nosy. I just have to see everything, basically. I need to know how many times you order from Uber, how many times you take an Uber. I literally need to know everything about your financial situation. They're going to ask, in most cases, for a 90-day transaction history for any account from which you're pulling your down payment. So that could be RRSPs, that could be a TFSA, that could be a regular savings or checking account, and we'll talk about that a little bit later as well. But in short, you are going to have to fork over quite a bit of documentation to prove where your down payment comes from. They want to make sure that you're collecting your down payment in a above board kind of way. They're going to look for things like large cash deposits or e-transfers that they can't trace. Usually the benchmark is $5,000. If there's more than $5,000 coming in a cash deposit or an e-transfer, they're going to flag it, they're going to ask where it came from. our job is to help you avoid getting into that situation where the lender is going to ask for more documentation. So in the time leading up to your purchase, let's make sure that your bank statements look clean. There's no large deposits going back and forth that we can't explain. Is basically the general rule of thumb. Sorry, Chris, can you go back one more?
Of course.
Yeah, sorry, and these are just the sources of down payment. Most common RRSPs, investment accounts, savings and checkings account. Most recently, crypto accounts as well. If this is something you're going to be using for your down payment, let's withdraw it from your crypto account and put it into a regular everyday account, and let's leave it there for 90 days before your purchase, just so we don't have any complications with that, because the inherently crypto is non-traceable, and that's not what the lenders want to see. Next slide, please. The only exception to this rule, the 90-day history rule, is a gift. So lots of people are having gifts from family members to be used for their down payment. For a gift, we need a gift letter, which is signed by that family member, and we need the proof of deposits. We need to see that amount being deposited into your everyday account, and that's all they need to see. So if you're getting a gift, we're not going to be looking for that family member's bank statements or anything like that. It's a little more streamlined. And down payment minimums. So these are the rules when it comes to the minimum amount of down payment you can put into your purchase. When you're purchasing under $1 million, you have to put 5% of the first $500,000, which is $25,000, and then 10% on every dollar on top of that. So for example, if you're purchasing at $600,000, you put $25,000 down for the first $500,000. The next $100,000 is going to be $10,000 because that's 10%. So altogether, $35,000 would be the minimum down payment on a $600,000 purchase. When you're purchasing over $1 million, which I believe is next. Yeah, sorry, this was an example. 700,000, 45 grand is going to be your minimum down payment. Here's the calculation here, but I basically just explained it. When you're purchasing over $1 million or at $1 million or over, you have to have minimum 20% down. When you're putting less than 20% down, you have to pay mortgage default insurance. So this is something that the lender requires because essentially you have less skin in the game. You're putting less down payment into the purchase. They require you to purchase default insurance, which is if you default on the loan, the insurance company is going to pay the lender back for the mortgage, essentially. They charge you the insurance premium based on the amount of down payment. So if you're putting the minimum between 5 and 9.99, your default insurance premium is going to be the highest at 4%. And this is the percentage of the mortgage amount that you're paying. What happens is they take that insurance premium, they add it to your mortgage, so it's not something you have to pay out of pocket on closing, and essentially you're paying it off over the lifetime of your mortgage. What you do have to pay, as Anya mentioned earlier, is the sales tax on that insurance amount, which depending on the purchase price and the premium amount, you're paying between $1,000 and $3,000 extra on closing, which is the sales tax on the insurance premium. Next slide, please. Here we go. When you're purchasing at $1 million or over, your minimum down payment is 20%. So if you're purchasing $1 million, it's a minimum $200,000 down payment. And then of course it goes up from there. It's always at 20%. When you're getting into luxury homes and we're talking like $2 million, $3 million, sometimes they even require more than 20% down, and they have a sliding scale in that respect. And lastly, we're going to talk about credit. So different types of credit are important to have. What happens is I pull your credit bureau. We use Equifax as mortgage brokers, and essentially that gives me a whole breakdown of your entire Canadian credit history. They look at different types of credit. So you want to have installment credit and you want to have revolving credit. So installment credit is something like a student loan or a car payment, for example, where you're borrowing a certain amount and you just make monthly payments and you pay it down and then it's done when it's done. You also want to have revolving credit, which could be a personal line of credit, which could be a credit card. It's something that you can withdraw from and pay down as you see fit. And having different types of credit shows the lender that you're able to basically handle different types of credit, different amounts of credit. If you have multiple credit cards with different limits, it's always good to have diversity on your credit bureau, and that will help increase your score, and it will help the lender to consider you a more credit-worthy borrower, essentially. Here are my recommendations for credit. You always want to start early. So I know there's that thing where your parents don't want you to get a credit card because they think you're going to max it out and be totally irresponsible with it, which is definitely possible, but instead what you should do is start early and not be irresponsible with it. The general rule of thumb is don't go over half of your limit. So if you have a $5,000 limit on your credit card, don't go over $2,500. Of course, use it regularly is important as well. So if you get a credit card but you never use it, it's neither here nor there because there's no history on it. You always want to pay on time, obviously, so at least your minimum payment every month, you want to pay on time. If you miss payments, it will show up on your credit bureau and it will negatively impact your credit score as well. And as I mentioned earlier, make sure you diversify, so having different types of credit, student loans, car loans, credit cards, personal lines of credit, and that kind of thing. I had a conversation with a client the other day, and she said, oh, I thought that accepting credit increases from the bank was not a good thing. I always said no, and she only had one credit card and it had a limit of $1,500. She'd had it for 5 years, but what just doesn't show that she's credit worthy, that she's good at using her credit, and so the lender may not approve her if she was the only borrower on the file, just because she doesn't have that depth and maturity of credit on her file. And for credit scores, the general rule of thumb is a 680 plus credit score will get you prime rates. If you're below 680, we're going to be looking at alternative lending, maybe a little bit of a premium on your interest rate as well. But if you're 680 or higher, chances are you're eligible for the best rates out there. We'll talk really quickly about first-time buyer benefits. I think this applies to everybody in the room. So I know Chris is going to elaborate on this a little bit later as well, so I'll just go through it quickly. But RRSPs, so you can, as per the Homebuyers plan, you can withdraw up to $35,000 tax-free from your RRSP per borrower as well. So if there's 2 borrowers on the file, you can withdraw up to $70,000 tax-free to put towards your down payment. The land transfer tax rebate, so if you're purchasing in the city of Toronto, there's 2 land transfer taxes, one to the city, one to the province. Chris is going to talk about that later as well. But you can get a rebate. It's not so much of a rebate, but you just don't have to pay it in the first place, right? Correct. Chris does the adjustments and shows you that you're going to save a bunch of money on your land transfer tax if you're a first-time buyer. The down payment incentive program, so this is something that the government put into place recently, and it can help you add 5 or 10% to your down payment as well. Just keep in mind the government is going to have an equity stake in your property if that's the case. And the new tax-free first home savings account, they probably could have thought of a better name for it, but it is what it is. And essentially you can put away a certain amount of money every year, and it works similarly to the RRSP. It's a non-taxable savings account that you can use towards your down payment to a maximum of $40,000.
40.
Yeah, $40,000.
You also have a maximum annual contribution too, so I think it's really impractical personally, because I think it's only $8,000 a year. Yeah. I mean, at that rate, it'll take you
a long time.
Please help me.
A long time to save up your down payment.
At least 5 years.
Yeah.
Yeah. And by then, property prices are going to go up, and it's just, it's not the greatest way to save money. It's
an option. That's
it's an option in addition to others.
We'll talk quickly about co-signers and guarantors. So a lot of first-time buyers these days, they have help from their family in some way, whether it's a co-signer or a guarantor, or whether it's gifted down payment. It's tough to get into the market these days, we know that. And so a lot of my clients are needing help in some way, shape, or form. The difference between a co-signer and a guarantor, essentially a co-signer will add income to your file. So if you do not have enough income to qualify for the mortgage that you want for the property that you'd like to purchase, you're good to have a co-signer on the file. It's usually mom or dad. And you need somebody with good credit, you need somebody with strong income and not too many of their own debts. So if your parents are retired and have their own mortgage payment and their own car payments, they're probably not the best co-signers because they don't add as much value to the file as we may have previously thought. We want somebody with good income and not a lot of their own debts. Like I said, almost always a family member, and the defining factor of a cosigner is that they will be on title and on the mortgage, so they will be an owner in the property. You can arrange that in a certain way in percentage of ownership to help maximize your first-time buyer benefits, and Chris is going to touch on that a little bit later. And with a cosigner, we have to factor in all of their assets and liabilities, like I said before, so we're going to look at their income, but we're also going to look at their debts. With a guarantor, it's not as common as a cosigner, and with a guarantor, it's if you have limited credit or poor credit, you bring a guarantor on the file to help add credit worthiness. So in the situation we discussed before, where my client only had one credit card with a low limit and she didn't use it very often, we need a guarantor on that file. We needed dad to come on. He's had 3 mortgages and 3 cars, and he's got mature credit of 20 years in Canada, and he's a great guarantor on the file because it adds credit worthiness to the file. It's basically the lender having reassurance that if she can't make her payments because she doesn't know how to use credit properly, dad can step in and help. That usually never happens, but the lenders always are worst case scenario type people, and they want to make sure they have all of the backup there. Sometimes it's not always a family member. We can do close friends sometimes, or more extended family like aunts and uncles and grandparents and that kind of thing. In certain cases, they can be left off title and off the mortgage as well, so that's a benefit of being a guarantor. The mortgage may not show up on your credit bureau and you won't be on title, so that responsibility will be yours as the guarantor. And the assets and liabilities don't usually factor in, so we're not so much worried about income and debts as just they want to have strong credit to be a good guarantor. Yes, so to boil it down, as a co-signer, they'll add income to the file to help you qualify for more in a mortgage, and as a guarantor, they'll help you when you have poor credit or limited credit. Thanks, Chris.
No problem.
Okay, we'll talk about the stress test. So, I'm sure it's something that you've heard of if you've been doing any kind of research on mortgages or purchasing. Essentially, it came into effect in January of 2018, and what it means is that we have to qualify you for a mortgage that is actually more expensive than the mortgage that you're getting. So, the general rule of thumb, and I think it's on the next slide, is that you have to use either your actual interest rate that you're getting plus 2%, or the benchmark rate, which is 5.25, which these days is not a thing anymore because interest rates are higher even than 5.25. So we're qualifying you in the 7% range. We're making sure we qualify you for a more expensive mortgage than you're actually getting. And the idea is that if interest rates go up, which is something we've been seeing quite a bit recently, you're still able to make your payments, and they give you that 2% buffer essentially.
I guess before we begin, the Law Society of Ontario obliges me to give a lovely disclaimer here and say that this is legal information only. It does not qualify as legal advice. And if you have any actual legal queries with regards to purchasing, selling, or refinancing a home, make sure you speak with a lawyer and retain them individually. All right? So, with that out of the way, the next slide, the first thing I want to talk about is ownership types. Now, once you've spoken with a mortgage broker, you've spoken with your realtor, you've had your sights set on a place that you want to buy, the first thing that a lawyer will ask you outside of just the kind of standard, getting to know your client and setting up a file is, how are you planning on taking ownership of the home? And most of the time they'll say, how are you planning on taking title? Which is a very awkward thing to ask somebody if you've never had that question come up. But that essentially is, how are you going to take ownership of the property? So at law, there's actually two types of ways that you own property if you're buying that property with more than one person. Okay? The first one we have is joint tenancy. Now, this is, in the scenarios that I'm going to go over, it's 2 or more people buying property together, okay? Joint tenancy is really common with spouses, both in common law and in traditional marriages, and family members, mom and dad, and a kid, okay? And essentially what this means is, in joint tenancies, if 2 or more people, if one person passes away, the surviving owner gets the house transferred to them automatically. It doesn't go through a will, it doesn't go through probate, it automatically transfers to the surviving owner, okay? This is a lot more convenient, especially if you're trying to sell the place, you don't have to get a probate application going, okay? And it is usually used so that it is for estate planning issues, okay? The second type of ownership that we have is tenants in common. Now, this is more common with distant relatives, friends, and investors, okay? And ownership is based on shares that you agree on. So let's say if 2 or more people are buying a property together and their down payment is different shares. So one person is putting in $80,000, another person is putting in $200,000 for a down payment. They are going to somehow come to an agreement on some terms about how that share in ownership of the property is going to be divvied up, okay? When one of the owners passes away, that share of the property will go into their estate, meaning that the surviving owner or owners will have to either sell their shares to liquidate the house, depending on what the estate decides, or they will buy out the surviving owner's shares, okay? And passing through, if you're deciding to sell a property, it is a lot more difficult because you have to go through probate and deal with fractional shares, okay? Now, one of the biggest issues when people are purchasing properties, especially as friends or distant relatives, right, or even property investors especially, is what happens when you are making large-scale decisions as tenants in common, right? If you decide to refinance the property, if you decide to make renovations or rent out the property, or if one person wants to sell the place and the other person wants to stay, these are bigger issues that need to be A, spoken about, and B, spoken about with a lawyer and written into concrete terms so that you are avoiding any kind of conflicts in the future with owning a property, okay? So next slide, please.
Now, again, one of the reasons why lawyers will ask, how are you planning on taking title in the initial stage, especially when there's 2 or more potential owners, is also because of land transfer taxes. Now, we'll go into this a little bit more in the slides later on. But essentially, if one or both people are first-time home buyers, right, they're subject to rebates. If one person is not, they may actually have no rebates in the land transfer tax. So it depends on the positioning of what's going on. Also, how major decisions are being made, right? We went over that in joint tenants and tenants in common, estate planning issues, and also the complexity of how that purchase is going to go through, right? What may seem like a very straightforward approach when you're saying, oh, let's say 2 friends are buying a place together and living there as roommates. It may seem like a pretty straightforward, I'm putting in X amount and you're putting in X amount of money, but when it comes down to making larger life decisions going over in the years, right, that's something that a lawyer will kind of have to tease out of that person and make sure that those things are agreed upon, right? Next slide, please. So, I'll have a pretty easy example here of why this is important. So, Homer and Marge are thinking of buying a property together as joint tenants. So going through this, if Homer passes away, Marge will get the property outright. All they have to do is get a survivorship application, and if Marge decides to sell the place, then it's a faster sale because now she's the sole owner of that property. Okay, and the next slide, please. The second example is tenants in common. So, Smithers and Mr. Burns are buying a property together, and Smithers is putting a measly 30% down, and Mr. Burns, who is very wealthy, is putting 70% down for a down payment. So if Mr. Burns decides to pass away, his ownership goes to his estate. His 70% ownership goes to his estate, and if Smithers decides to either live in that home, he has to either buy the share from Mr. Burns' estate or sell his share, depending on the bargaining power. In either instance, if there's a sale, they need to get probate, and it's dependent on the timing of the estate and the timing of the government for applying for a probate application. Okay? Slide, please. So, this is going to be a little bit more of the dry side, as expected for a lawyer. We're going to be talking about taxes, which nobody wants to talk about, and that's why we're here. So, land transfer taxes. What are land transfer taxes? Essentially, land transfer taxes are for any time that you buy residential property here in Ontario, the government charges you essentially a sales tax, okay, for lack of a better term. It's charged on the day of closing and is included in the final amount that you have to give to your lawyer to pay off for the sale or for the purchase, okay? And the land transfer tax is calculated based on the purchase price of the home. All right? So next slide, please. Now, land transfer tax is based on the purchase price of the home, and it's based on a sliding scale. So the value of the rates here are reflected as basically up to and including $55,000. It's taxed at 0.5%. The amount after that of $55,000 and a cent to $250K at 1%, and then it goes forward to $250K plus and a cent to $400K is 1.5, $400K and a cent to $2 million is 2%, and over $2 million is 2.5%. So it stacks on top of one another when they're calculating the taxes. Okay. Look, I'll be very frank with you. Lawyers are notoriously bad at math. Okay. So the internet has blessed us with lovely land transfer tax calculators to give you a rough estimate of what you would be paying at closing for land transfer taxes, okay? Now, lawyers also have their own back-end programs to be calculating the final amount that's due, but it's a good way when you're initially looking at a property to calculate land transfer taxes into your final closing costs to be using these online calculators, okay? I recommend RateHub. RateHub is really good. You know, there's all sorts, but doing the math by hand is essentially not the smartest idea, okay? Next slide, please. Okay, so we're just gonna go into a quick example here. Homer and Marge are deciding to buy a property in Oshawa for $1.2 million. So the land transfer tax, after doing the calculation in a lovely land transfer tax calculator, the land transfer tax would be $20,475 that you would have to pay at closing. Okay, so that's in addition to the purchase price that you have to factor in. So if we look at the second example, or now we're going actually into municipal land transfer taxes, even more fun. So if you're buying within the city of Toronto, we have an additional land transfer tax that basically is going at the exact same rates as the provincial land transfer tax that we had just seen in the table before. Okay, so it's tax and another tax that they're putting on top. So in this second example, Homer and Marge are now buying the same property at $1.2 million, but it's in Etobicoke. The land transfer tax is going to be $20,475, and then the city of Toronto also charges you an additional municipal land transfer tax of $20,475. So that total comes up to, next slide please, a whopping $40,950 of tax payable on closing that you'll have to factor into. Okay? Let's talk about first-time homebuyer rebates. Like I said, all hope is not lost. Okay? The government, realizing that taxes are quite heavy, especially for first-time homebuyers, they've decided to allow for a first-time homebuyer rebate of a certain amount that they deduct at source that you're obligated to pay. Okay? So that portion is deducted at the final day on the day of closing, so you're paying less amount of what that amount that you should be charged for. Okay? So next slide, please. So who qualifies? That's the number one thing that we want to talk about as a first-time home buyer. Who is a first-time home buyer in the government's eyes? Well, first you have to be 18 years old, you have to be a Canadian citizen or a permanent resident, and you have to occupy the property as your principal residence and have never owned a residential property anywhere in the world. Okay? That means that you can't have an inheritance of some sort of a vacation property, let's say in Mexico. You can't have a gift that was previously given to you that maybe that you're unaware of. So you have to be very careful, especially as first-time home buyers, to ask family members if you're on title for a piece of property that maybe you were there, that your parents had put on for some, a gift in the future or a down payment, right? So next slide. Now, how much is rebate? Well, in terms of the provincial amount, you are eligible for a rebate of up to $4,000 on your land transfer tax, and the municipal portion, you're eligible for a rebate of up to $4,475. It doesn't seem like a lot in the grander scheme of things, but hey, I'll take whatever I can get at this point, right? So next slide, please. So let's use an example of Homer and Marge again. Homer is a first-time home buyer, and he's now just buying the property himself at $1.2 million. If he buys that property in Toronto, it's $20,000 minus $475. So his land transfer tax will be $16,475, and his municipal land transfer tax portion will be $16,000. Okay? So the total taxes payable for him would be $32,475. So a total of, $8,475.
$84.75.
Yeah, $84.75. There we go. See, lawyers and math. Okay, so let's talk about the fact that if you're buying as a first-time home buyer, you're purchasing with someone who is not a first-time home buyer, who's owned a home before. What happens in that case? Well, if one or more of the people are not first-time home buyers, the rebate could either be reduced, or in some cases, it can be wiped out completely. Okay, you might not actually get the whole entire the rebate at all, and it's usually dependent on the type of ownership, so joint tenants and tenants in common, and marital status. Okay. So let's look at this again. Homer's a first-time home buyer, and he's buying a property with his dad, Abe, who's owned homes before. So they're both buying as joint tenants. Homer will only be able to use up to 50% of his first-time home buyer rebate. Okay? And that means that the land transfer tax rebate that he'll be eligible to use is $2,000, and his municipal land transfer tax amount will be $2,000 $237.50. That's the max that they're able to use if they're joint tenants. Okay? The next one, please. In the second example, if Homer, again, is a first-time home buyer and Abe is not, but they're tenants in common. Now, this goes back to speaking with a realtor and also speaking with your mortgage broker to make sure that this is possible and the lender is allowing this. So it's dependent on the co-signer and the guarantor portion that Jacob had alluded to earlier. Okay? But in some ways, we are able to technically structure the transaction depending on, again, the owners agreeing to this as a tenants in common situation where Homer is able to maximize, as a first-time home buyer, 99% of his entitlement as a first-time home buyer, and Abe would technically just own 1% of that property. In that case then, Homer would be able to get a rebate of $3,960 and a municipal land transfer tax of $4,430.25. Now, this again comes with risks, right? That the lawyer would have to advise the 1% owner about, is that they only have 1% ownership, but depending on how they're on the mortgage, they're still on the hook potentially for the whole entire mortgage if Homer can't make do with the mortgage payments, right? And also that it's still a piece of property and an asset, so there are legal responsibilities that Abe has to take care of despite being a 1% owner, all right? So next slide, please. Now with spouses, this is a different, first-time homebuyer rebates are a different world onto its own. Now, one of the things I always advise when I hear of couples purchasing property together is that spouses doesn't mean just traditionally married couples. It also includes common law couples, okay? That's one thing that we have to know. Now, one of the major things with spouses and first-time homebuyer rebates is that if one spouse is not a first-time homebuyer, the rebate gets technically wiped out entirely. That means that unless the spouse has ever owned a property but got rid of it prior to being a spouse of that person, they're basically out of luck and they have to get taxed the full amount of land transfer tax. Okay?
Is that only if you claim common law when you do taxes?
So, technically speaking, it's common law is if you have lived in a relationship of some permanence, in a continuous relationship for 3 or more years, okay? Now, if you claim on your taxes as common law, look, I have to go by what you tell me, but I also, if I see that there's an inconsistency, I can't work with you based on the fact that it's inconsistent with, you know, so don't lie to your lawyer, essentially, is the main thing, right? And you also risk auditing, and you also risk financial penalties. So that's never a good idea. But in essence, what I'm trying to hone in on is that making sure that you are, if you're going to buy a property with someone in a common law relationship, you should also be aware of these things no matter what going forward, right? So that, you know, you're aware of the risks involved, and so just basically don't ever lie to your lawyer. I see we have a question back there. I will be answering questions at the end, but I will note that, just make sure. Thank you. Okay, so let's go to another example here. I know I'm boring you guys with a bunch of examples, but Homer's a first-time home buyer, but his wife, Marge, has owned a condo in Ajax that both of them are currently living in. That would mean that they get no rebate if they're buying a home. Now, in the second example of Homer as a first-time home buyer, and Marge had sold her condo prior to Homer proposing to her, Homer may be entitled to a maximum amount of the first-time homebuyer rebate of 50%. Okay? There's specific nuances to that in terms of how the other spouse, who is not a first-time homebuyer, had disposed of that property. Okay? And that's something that you need to discuss with your lawyer to see whether or not you qualify for the first-time homebuyer rebate. Okay? It's not just as simple as I sold it. Usually the lawyer will ask for some proof. They'll ask you to fill in certain forms that are complementary to the wider application that your mortgage and the legal documentations will rely on. Okay?
The first portion is the deposit. This is not the same as your down payment. It is a portion of funds that you will provide to the seller. It'll be held by the listing brokerage upon an accepted offer. However, I always recommend that you have this amount ready once you start your search, because once you have an offer accepted, you have 24 hours to submit the deposit. And if the funds are in an investment account or with a online bank like Tangerine and you can't get a check, you want to make sure that you have the money. So the deposit in Toronto is typically 5% of the total purchase price, really mostly for Ontario. So budget 5% of your maximum budget. If your budget's $1 million, make sure you have $50,000 liquid in an accessible bank account right from when you start looking. Another thing to note is that it counts against your down payment. So it's not in addition to what you would owe on closing, it's subtracted from your total down payment. If you happen to only be putting 5% down, then you wouldn't owe any additional down payment on closing. You would just be paying your closing costs. And last thing to note about the deposit, depends on the market that you're in. In a seller's market where you're competing with other offers, it's usually beneficial to have your deposit ready with your offer. So I would give you the deposit instructions and send you to the bank to get a check for 5% of your approximate maximum budget, and you would have that. So if your offer is accepted, I would literally drive to your house at midnight, pick up the check and drop it off to the listing agent. I once drove to Mississauga at 1 in the morning, I live in Leslieville, with a check because our offer was accepted and I promised the listing agent they would have it that night. So it happens. But yeah, so that's called a deposit herewith. And then when you're dealing in a buyer's market or you are the only offer, then you would typically give it once the offer is accepted within 24 hours. You can go next slide. Okay, offer process. Once you've submitted an offer, I'm not going to go through as much of the showing process, but when you are submitting an offer, you find something that you like, I will ask you a series of questions. I usually start with these questions ahead of time, just to make sure, like these guys have talked about, there's no issues in terms of foreign ownership that we need to deal with ahead of time. But you know, I'll need your ID, I'll need a bunch of information from you that may sound invasive. I'll probably ask if any of your family is like a foreign politician or the head of an international organization. I'm not being nosy, I need to know these things before I submit an offer. But 3 facets. When you've submitted an offer, you will either have the offer accepted, that's great, it's a done deal. You'll either have the offer rejected, maybe the property is listed for $1 million, you submit $950 and they are not interested in working with you, that's a hard no. And the last and most common is that you'll negotiate. You'll either receive a counter offer from the seller, or when you're dealing with multiple offers, the seller will actually come back and ask you if you can improve your offer. So it's almost like a second round of offers. One thing to note is in Ontario, as it stands, offers are always blind. You are not allowed to know the contents of any other offer. If there are 3 offers on the table, the seller cannot disclose to you what the other offers are. If you offer $900,000, you will not know what the other buyers have offered. This is something that the province has talked about lifting potentially, but as it stands, you have no idea. So you are going in blind. If you're asked to improve your offer, I do my best as your agent to get an idea of how much we need to go up so that you're not overspending. But usually I say when you're competing, go in with the price that you are willing to lose at. If you don't get a chance to improve, will you regret not putting an extra $5,000 down? So that's kind of the key thing. Now, when we're dealing in a slower market, it's more likely that the seller will submit a counter offer, and that's essentially when the seller changes details of the offer and submits it back to you. At that point, you are not bound to the new terms of the offer that the sellers have put forward. You are only bound when you submit an offer to the seller. From that, we can either counter again, maybe they went too high, you want to go lower, or you can accept it and move on from there. 2 main kinds of offers. There are firm offers and conditional offers. This also really depends on the market that you're in. In a faster paced seller's market, like 2 years, we couldn't use any conditions, no conditions. Everyone was going in firm. I'm sure you've heard stories from friends or family, but you had no ability to do financing conditions, no ability to do any sort of review after the fact. So you were forced to do all of your due diligence before submitting the offer. And like I've had clients submit upwards of 10 offers, which meant 10 times they're calling Jacob to find out what their max budget is for this property. They're calling Chris to review something called a status certificate, which we will explain later. But you had to do all of your due diligence ahead of time, and that sometimes gets costly, and it's also really exhausting. But now that we've moved into a slower market, you have a lot more leverage. So you can go in and submit a conditional offer. It is still it's still a legally binding contract. However, it's essentially an out. So if you go in with a financing condition, then that means that your offer is conditional on you obtaining financing or a mortgage for the property. So you can go to Jacob, say Jacob says, you know what, you can't get enough, like you can't qualify for this price, then you can back out and get your deposit back. If you go in firm and that happens, then you're more than likely going to lose your deposit. The other two main conditions that we see are for houses, we'll see home inspection conditions, and for condos, we will see status certificate review conditions. Chris will review the status certificate of a condo and will essentially tell you if there are any red flags, anything you should know before you proceed. I will tell you that you should absolutely never in a million years buy a condo without having the status reviewed, whether it's before or after the fact. But I'm going to leave it to him to explain what a status certificate actually is. You can go to the next slide. Okay, details. I'm super detail oriented. I learned when I was buying my own house that there are a lot of things to miss. Usually when you're buying your first place, you're really focused on the things that you like. You like the fridge, you like the kitchen island, you like the floors, but you don't look at the things that you don't like or that may go wrong in the future. So with my house, my own personal experience, I have a front room which is set up as an office. I didn't notice when I was looking at the house that there's no heat source. So that small room, I think they just blocked off a bedroom and made it a second space, but they didn't add a heat source. So when I'm working in the winter or the summer, it's really hot, really cold. That's something that I should have noticed beforehand, but I didn't. Other things like the floorboards shifting, stains on the ceiling, if there's been water damage, these are all kind of things that you don't really notice, especially when you're buying your first property, and it's important that your realtor is doing more than just opening the door and saying, wow, look at the nice stove. Like, you want someone who's actually digging and looking for the problem, because you don't want to find out after you've already spent all the money that there are issues. Another really annoying thing that I found out after I bought my place was that the bathroom, there's a hole in the door because the door is too close to the toilet. So in order for the door to close, they had to cut a hole in the door. So it's really tight. And I also have no fan in the bathroom. So in the winter when we're showering, we have to open the window and it gets really cold. So things that I didn't pay attention to and I noticed afterwards. And the last thing is mice. I have a terrible mouse problem. Most old houses have mice, I'll tell you that, but now when I look at houses, I look in the places that I know my mouse droppings will be, because you want to know ahead of time. Like, the mice are the bane of my existence. I'm dealing with them all the time. They're really annoying, but anyways, that's that. And the last thing, one of the most important, is ambiguity in offers. So when I do an offer, I'm very particular with the details that I put in. There are some horror stories where people were not specific enough with what was included. And example, someone wrote things that are included, washer and dryer. The sellers left a hairdryer because they weren't specific enough that it was a clothes dryer. So when you're buying, usually with more high-end purchases, you'll put the actual model number of the appliances, because those aren't typically included in the sale. You need to note that they're included. You'll put the model number. I always specify like stainless steel appliances, and I'll note every single appliance. Always like clothes washer and dryer. If there's anything that you want, making sure that we write it very clearly, because if you're dealing with a shady seller, they will take anything that they can, even like swapping a $3,000 stainless steel fridge for like a cheap white, like the old ones that nobody wants, a white fridge, if you don't specify. So those are some important things. Same thing, like, are there light fixtures included? Are the curtains gonna stay? These are all details that the standard offer will just say like all appliances, clothes, like washer and dryer, and that's it. We need to actually note everything specifically in order to protect you. Small details, really important. As long as you're working with an agent that is very detail oriented, you should be fine. But if you're working with your cousin Sam, who doesn't ever sell houses unless they're selling to a family member, they might miss these things and it might turn around and bite you later.
So guys, just to fill in on the last bit that Anya talked about, I actually thought I'd really kind of delve in a little bit more about what chattels and fixtures are. So in your purchase agreement, the things that are most likely going to be included that you'll see in a purchase agreement are called chattels and fixtures, okay? What's the difference? Chattels are essentially movable items. So all your appliances like your fridge, stove, washer, dryer, etc. And fixtures are all the types of items that are affixed to the property that you can't easily move, okay? We're talking about a hot water tank, a furnace, if you have a backyard pool or a hot tub or something like that. Most of these items are standard, right? So your washer dryer, if you're getting a house, your hot water tank or a furnace, these are all things that are standard and are included in the purchase agreement, and they're included in a section that specifically states that those are included. However, as Anya said, the seller has the right to exclude certain things from the sale, okay? So let's say, for example, they have a really nice brand new washer dryer that they just bought 2 months before putting the place on market, and they want to take it out. They can exclude that from the purchase agreement. So it's always important to A, look at the listing, and B, speak with your realtor to make sure that those things are included, right? And that they're included and specifically put into the model number itself, right? Or the specific item that's put in, right? Why am I also bringing this up is if you are buying a property specifically because of the chattels and fixtures, let's say that you're buying a property and it has a beautiful kitchen setup with a brand new set of, a stove, like a gas cooktop, beautiful, Wolf appliances I've heard are very nice.
Like $10,000 stove.
Yeah, see, $10,000 stove. You have a really nice, even furniture, right? If those things are not included as standard things, but you want that property specifically because of those items in that home, either A, expect the seller to say no, or B, that they may include an additional amount in the purchase price for buying those things. So it's important that A, you speak to your realtor about that, and B, make sure that you also let your lawyer know so that that's included in the purchase agreement, that they can kind of speak to each other to make sure that those things are included, okay? So I'm going to turn this over to Jacob.
Yeah, this will be me real quick. I don't have too much to say here, but essentially my job during your search is just to make sure that you are qualified for the properties that you're going to be putting an offer in. So we do all the due diligence up front. I collect all the documentation. We check your credit. We get the pre-approval done. The pre-approval says you're eligible for this amount in a mortgage. So based on your income, your down payment, and your credit, this is what you would ideally be approved for, as long as the property itself checks out, with a possible appraisal that the lender might request as well. But the most important thing to note here is to please keep me in the loop as you look for your properties. What I like to do is give my clients my cell phone number, and you can text me at any time of the day, and essentially you can send me a link to a listing that you're going to look at. Maybe you're going to look at 5 listings over the weekend or something like that, and you can send me the link to all of them, and I can get back to you telling you exactly what the maximum dollar amount is that you can offer on each of those properties, because the variables for most properties are property tax, right? Every property has a different amount of property tax, and that's going to be factored in to your liabilities when we're qualifying you for the mortgage, as well as condo fees if you're looking for a condo property. So it's very important to keep me in the loop, and I'm very accessible. You send me the link to the listing, I can let you know right away what your maximum purchase price is for that particular property, so then when it comes to offer night, you know exactly what to expect, and as far as what your maximum offer can be. If there's anything that changes in your financial or employment situation since the pre-approval stage, that's very important to let me know, because that's definitely going to affect your pre-approval amount and the amount that you're going to get approved for in the future. So any changes like that, definitely let me know right away so we can make some adjustments if necessary. And the last thing I just wanted to point out is that you definitely won't get in touch with anybody at the bank at 9 o'clock at night when you're looking to put in an offer. So just another advantage of using a broker is you can text me at that time, you can email me at that time, and just let me know, can you check these listings for me, because it's offer night tonight and we want to make an offer and we want to know what our maximum budget is. Maybe you go in with an offer and you want to know if you can squeak another $10,000, $15,000 in there to be the winning bid, and so I can definitely let you know if that's possible for your situation.
To make Jacob sound good too, I've sent many clients his way that have ended up with higher budgets than they got from the bank, because usually the financial institution is not nearly as diligent in trying to find creative ways to increase your budget or shopping around with options. So there are way more benefits to using a mortgage broker than a financial institution. Yeah, they're like, I have clients that have been waiting for 2+ weeks to get their pre-approval back from a financial institution. They never get responses to their emails. One had a pre-approval submitted to the lender, and the guy made so many mistakes. They rejected her application outright, which means that she cannot apply for another like 3 months, which is ridiculous. Anyways, use a mortgage broker.
Thanks, Anya.
You're welcome.
So sweet.
Thank you.
I will note that Jacob did help me with my purchase. He was my mortgage broker, so I can vouch that he does pick up phone calls at 9 p.m.
Oh, you guys.
Don't cry.
Nice. Okay, next slide, please.
All right, so I'm back again to bore you guys. But let's talk about status certificates. Now, what are status certificates? These are specifically for if you are buying a condominium or a condo townhouse, okay, here in Ontario. A status certificate is essentially a snapshot of the condo development at a given point in time, and it goes over the financial and legal health of the building, okay? Some of the things that must be included in the status certificate are the most recent budget, the most recent audited financial statements, the rules and bylaws of the condo, something called the reserve fund study, which essentially is an auditing report of how much of a reserve fund, which is essentially a piggy bank of a rainy day fund for when the condo needs to make any major improvements or renovations to the condo development, and any third-party contracts and the insurance certificate for the whole entire condo development, okay? Now, why is it important that we have a status certificate? Well, essentially it allows potential home buyers to assess the financial solvency of the condo development. You get to understand the age and legal health of the building, if it has any kind of lawsuits ongoing, if there's any recent floods or major damage issues. And most likely the mortgage lender will actually require a copy of the status certificate to make sure that it is within their risk assessment to be funding that property. So while you may have a pre-approval of X amount, if you have a status certificate that looks like it's, you know, terrible, they're most likely not going to fund it. And that has happened before, where actually the next slide will actually talk about that a little bit more, but which actually Anya actually alluded to earlier, is why you should never waive a review of a status certificate. This is something that is given at the offer stage and is conditional on, you know, let's say you put an offer, the seller says yes, you always want to put in a condition that you are satisfied with the status certificate before you're able to move on to the next stage of the purchase. And the reason why you never want to waive a status certificate, in my opinion, is at least waiving it is very risky, okay? If you don't have one that is financially solvent, your lender may just say, nope, I don't want to fund this deal, go and find another lender. At that point, Jacob's scrambling to get another mortgage set up, most likely at a very high rate, right? And it also doesn't offer any protection to you as a buyer. Say, for example, you have 3 large golden retrievers, and the condo actually has a rule saying that there's no pets allowed other than service animals. Well, now you have a place where you can't live with your 3 dogs that you love, right? So that's not a good thing. Or you find out that there's a bunch of problems with renos, or you know, there's been a flood in the building. These are things that are always important for you to review with a lawyer when going through a status certificate.
Another really important thing that you'll see too are if there are any like planned maintenance fee increases, because sometimes, usually if something looks too good to be true, it is in Toronto. And sometimes the status will say that there's a plan to increase the maintenance fees by $60 a year for 5 years, and that's something that'll help you with your budgeting, but also certain buildings have been blacklisted by lenders, so really important to make sure there's no like major lawsuits. I know Chris looked at a status where the building was being sued, the developer was being sued by the building because like of structural defects, like major stuff, and the building seemed very nice. So, you know,
I've had I could honestly sit here for another 2 hours just talking about reading status certificates and having clients go, oh, you know, it's not a big deal. We love the place. We're really good with it. And I'm like, please don't waive the status certificate. They're like, okay, well, how much is it going to cost and all this? And fine, I understand the cost is a consideration. But once I go over the status certificate and I ask them questions, like for example, do you have pets? Are you a smoker? Are you thinking of doing any renovations on the condo unit itself? And if all these questions come back, well, let's say I'm, I don't plan on quitting smoking for the rest of my short life, and I insist on smoking in the condo unit. If they have very strict rules against smoking in your unit, I don't think you're going to be enjoying your time in that condo, right? Or if you have pets, which is a very big one. Or you find out that the place has had several lawsuits. Those are huge items that people just decide, especially during a seller's market where there's competing offers going in. They want to make their offer more attractive by waiving a status certificate. I always say that that's a bad idea because you don't know what you're getting yourself into. And you always want to be able to have some comfort knowing that it fits your lifestyle at the very least, let alone the financial side of things.
Also, to toot Chris's horn a little bit, I've had scenarios where clients wanted to submit a bully offer, which is an offer before the set offer presentation date. And this was actually the first deal I ever did with Chris. I reached out to him at like 4 p.m. on a Sunday, and I was like, hey, so I want to submit an offer like in an hour. Can you look at this status and let us know if we're good to go? And he was there, he did it. That let us go in with a firm offer. He made sure everything was okay ahead of time. So you can do the review before and then go in with a firm offer, but never don't do the review.
Yeah.
So yeah, great. Not all lawyers are like that.
Thank you, Anya.
You're welcome.
Okay, so during the closing period is our last, and we're going to touch on closing day as well. But essentially, this starts once you get your offer accepted. So once your offer accepted, we're call it the closing period. Usually the closing period is between 30 and 90 days. It's something that you negotiate with the seller. Your realtor will do that for you. That's more Anya's area of expertise. But just to give you an idea of where we are in the process now, for my purposes, when your offer gets accepted, that's when I kick things into gear and go for the firm approval for you. So we've had the pre-approval up until this point. Now we want to go for a firm approval. At this point, we will decide which lender is best for you. We may not use the same lender we did the pre-approval with. We will look for other lenders with better rates, better promotions. Maybe something's changed since the pre-approval stage as well. So we can direct you to the lender that works best for you in that respect. Obviously, we would love to have a financing condition in your offer, something we haven't seen too much of in the last couple of years, but more recently it's been more prevalent because the market has started to balance out a little bit. So during the financing conditional period is when I get to kind of work my magic and get that get the approval done for you. We get some paperwork, we look over it together. As long as you're okay with the terms and policies of the specific contract that I've got, you sign it and we move forward. If you want to look at other lenders, we're totally cool to do that as well. Like I said, it doesn't have to be with the lender that we did the pre-approval with. Next slide, please. At the beginning, like I said, I collect a bunch of documents from you, including letters of employment, pay stubs, bank statements, and all that stuff. Tax documents if you're self-employed. At this point, I send all of those into the lender, and the lender reviews those. So we have this closing period, the 30 to 90 days for the lender to review all of your documents, and for me to liaise with the lender. If they ask for more information, I come back to you. Maybe we need extra bank statement. Maybe we need a gift letter if you're getting a gift, or something like that. And we satisfy all the lender's conditions. Next slide, please. Once the majority of the conditions are satisfied, what happens is the lender will send instructions to your lawyer. They'll send instructions to Chris, which is basically a package of information saying this is how you need to register the mortgage on the property. And once all of the conditions are complete, the lender will move to ready the funds to be transferred to your lawyer, so your lawyer can do the closing process from there. I think that's it for me during this period.
Hi again. So one of the biggest responsibilities that a lawyer has is doing what's called the title search, okay? What is title searching? And before we answer that, we have to answer what is title. And title, in short, is the legal status of legal ownership on a piece of property. And what we do is essentially we do a title search and we look through the government registry to look at the property and its history of ownership and the types of things that are registered on that particular piece of property. So if we go to the next slide, please. What does a title search disclose? Well, it discloses who the previous owners were.
It discloses whether or not there's any mortgages and that the history of registration of mortgages and how much has been registered on that particular piece of property, and if they've ever been discharged or paid off. If there's any third-party claims, so if, for example, the government has some specific claim onto that property, if there's expropriation rights, if they have any kind of claims on that piece of property in terms of land endowments and things like that, which is rare in most of the GTA.
We're seeing it more with Metrolinx in areas around where the Ontario line might be.
Yes.
They're adding, yeah.
Yes. And then we also have easements, which in legal terms is a right of way. So that basically means that, let's say you own a property or a home and it backs onto a school. They might have a walkway that goes through your, side of your yard or side of your property so that people can go to and from the school onto the main access point, right? These are all disclosed in a title search, and we want to know what those things are because that might impact your ability to use that property or to own that property with a specific kind of right in mind, right? So we go to the next. So yes, our duty as lawyers is to make sure that the property is free and clear of title, meaning that practically all the mortgages that are discharged, any third-party claims, or any kind of debts associated with the property are either taken care of or addressed shortly or after closing, shortly before or after closing. Okay? Now, there are certain things that a title searches do not uncover. And back in the old days, we would do something called off-title searches. And these are essentially additional searches in different databases and in different registries that are not within the centralized government database for title searching. And they were expensive and not unified because not every property is the same and not every purchaser has the same kind of concerns. So for example, if a buyer that's buying a property, like a first-time home buyer, is buying a bungalow, but they want to tear it down and build up a brand new place, they're not going to have the same concerns as a young couple that want to move into that bungalow and make it their home for, for 5 to 10 years, right? So some of these off-title searches are quite expensive. For example, a survey. Getting a survey usually costs upwards of $1,000. Okay. Any open work orders, they have to look at the specific municipality and the specific kind of work orders that they are, and any permits and bylaws. All right. These are additional searches that the lawyer will have to conduct just to look at specific issues that are pertinent to that buyer. Okay. So back in the old days, a lot of people would rely on a solicitor's opinion, which essentially was the lawyer doing a title search and doing a bunch of off-title searches and then writing a nice letter going, on this day I have done X searches and I think that based on what you've told me, the property is free and clear of title and that you're able to purchase this property without any issues that impact you. Okay? The drawbacks were essentially that it was expensive for the client because there were additional charges that you'd have to do for looking up these different registries off title. It was time consuming, especially if you had to close within a specific amount of time. Some of these government registries don't respond to you for weeks to months, right? And it wasn't uniform and it didn't provide you with enough coverage. If something went wrong with the property or there was an off-title search that wasn't conducted that was actually pertinent, it would be very difficult to get a remediation to fix that property or some sort of financial remediation towards that, right? So then along came, next slide, title insurance, which we have a lot of clients ask us, what is title insurance and, is it home insurance? So first of all, title insurance is not home insurance. Home insurance is something that you'll have to purchase in addition to title insurance. And title insurance is for homeowners and their lenders, and it's a comprehensive no-fault protection against risks associated with real estate purchases. They also cover, in some instances, items where you may be sued or you are suing someone for something that is revealed in the title search. Okay? So title insurance typically includes coverage against any liens. So that's if you have the previous owner has not paid their utilities like hydro and gas, if they haven't paid their condo fees, or if they haven't paid their property taxes up to date. These are all off-title searches that are usually conducted, and they don't need to be done in the case that you're purchasing title insurance. Encroachments also are basically if, let's say for example, the previous owner had built a shed and it's backing onto the the neighbor's property. If that neighbor decides to sue because you're the new owner now, not only do you have to take down that shed, but if you really like it and you bought the place because of it, you might have to hire a lawyer to defend that. Title insurance will deal with that type of issue. And also it vitiates the need to get a survey, and it also most importantly deals with title fraud. In essence, now fraudsters are getting a lot more sneaky, a lot more smart about impersonating people and trying to pass themselves off as sellers to either get a mortgage illegally or to sell a property illegally and run away with the funds. Title insurance protects buyers in that instance. Okay. How much does it cost? One of the greatest questions that I think a home buyer could always ask, and it's important. It's a one-time fee and it's scaled to the purchase price of the home. Okay. Like every good lawyer, I can't really give you a yes or like a definitive price on it, but it is scaled usually against the purchase price of the home. Okay, roughly for a, just off the top of my head, if you're buying a place for about 800 to 900K, you're looking at title insurance policy anywhere on the low end of $400 to $500 to the high end of $800 to $900. Okay, the good thing is it's a one-time fee and it lasts for the lifetime of your ownership of the home. No monthly payments. It's a one-time premium of one-time cost. Okay? And next slide. Do I need to buy title insurance? The answer is, again, yes and no. Mortgage lenders are more likely to require you to purchase title insurance instead of relying on a solicitor's opinion. Also, a solicitor's opinion, which is the old school way, has a lot of drawbacks. It's actually more expensive or more likely to be expensive in comparison to title insurance. And there's less coverage based against title insurance. So the pros with title insurance as well is that it covers fraud, increased policy protection, and it ultimately saves you the money on charges and searches, charges in terms of legal fees and searches that a lawyer will have to conduct. And finally, we're just talking about what it looks like to purchase or at the very last day of closing day, right? How do we look at the purchase price? Now, I know this is really hard to see here, but I just decided to use, oh, thank you. I have my lovely pointer here that I decided to bring along. But we're going to use the same example of Margin Homer buying a property here in Toronto as first-time home buyers. So ultimately, you're going to ask, how much money do I have to bring in on the day of closing, right? What is the final amount that I'm going to have to pay? Well, the first thing we need is close to a week or two before closing, the seller's lawyer will provide to us what's called the statement of adjustments. And that'll show what the final purchase price is for the home that you have to pay. So if we look here, I'm not taking up the room here. So for a home of 1.2, Marge and Homer have already put down a deposit of $60,000. I really feel like a teacher doing this, which is really kind of scary. Now, because they're purchasing the property in late August, the seller has already paid the full amount of 2022 property taxes of $5,700, but they've only been living there for 237 days. That means that they should only be paying, as the sellers, $3,701.10. But since they've already paid that full amount, they have to credit that money back from the buyer's perspective. So it goes 1.2 minus your deposit plus the amount of adjusted property taxes, and the final amount that they have to bring in as buyers is $1,141,998. Sorry, Jesus, $1,141,998.90. I know that's the last thing you want to be hearing is a math problem at this hour. Believe me, that gave me a headache as well. But this is something that your lawyer will go over with you and show you what the final purchase amount is that is due to the sellers. Okay? So the next thing we have here is a trust ledger. Now this is what we as lawyers will provide to you as buyers to show you what the final amount is that you need to bring in as quote unquote your down payment plus your land transfer taxes and the funds, for closing, right? So if we use the margin homer example again, let's say that TD has organized a mortgage of $865K for them to buy that house. That means that the land transfer taxes that both first-time home buyers is $16,475 and $16,000. The government of Toronto likes to charge you $93.63 to administer land transfer tax. What they're administering and what they're doing, I have no idea because it's done by a computer. So that's some pretty expensive electricity fees. And the government will charge you $157.58 to register your deed and your mortgage. So in essence, essentially, what the final amount is that you're going to be bringing in is dependent on A, how much you're getting on your mortgage, and B, the land transfer taxes that are owing, and then your legal fees, which are at the bottom. So your title insurance and all the other disbursements here. Okay? So your final amount in terms of margin homer would be this right here at the top, 312,765.37. I know that I'm going over this a little bit faster than I would like, but I would really hate to mess up the numbers anymore than I'm already doing. So I'd like to kind of save you guys the headache of, me explaining things in mathematical terms.
Buyer visits. This is pretty much all I have for the pre-closing period. So once your offer has been accepted, usually your agent will put in a clause that you are entitled to 2 to 3 visits to the property before closing. Usually the first one is if you want to bring a family member through, maybe you want to show your parents, maybe you want to take measurements, maybe you plan on renovating, you want to bring a contractor to get quotes, estimates. That's kind of what you can use them for. But the last buyer visit is the most important one. You write that one off. That one I'm keeping for you. It's when we go in. We usually go in a couple days before closing and we check everything. So usually when I do an offer, unless it's a really old house that's being sold in what's called as-is condition, I'll have a clause that states that the chattels and fixtures are to be left in good working order. So the fridge, the stove, the washing machine, all of that needs to be not only there, but working. So we're gonna go in, we have an hour, I test every appliance, I run the washing machine, I run the I run the dryer, I run the oven, I do all of it. And we also use that to check to see if anything that was supposed to stay was taken. Maybe they took the stove, maybe they swapped something. If anything's not working, then that gives us time to have the sellers repair. And if they don't have time to repair it, then Chris will do something that's called a holdback, and they will hold a certain amount of funds back on closing because of that. Also, maybe they took the blinds or they swapped anything, pretty much just to make sure that everything that was agreed to in the initial offer is still applicable on closing. Next slide. Closing day. I will preface this by saying that closing day is super anticlimactic. Everyone expects it to be this like big thing. It's going to be like a big celebration. It's literally a text or an email from your lawyer saying like you're done. But yeah, very anticlimactic and also quick.
One of the very first times that I closed a property and I called the client and said, well, congratulations, you have your home. They're like, well, what do I do? I'm like, you pick up your keys from my office and that's it. And they're like, you don't like give me a document that like says that I'm like a lawyer, like, that I legally own the place. I'm like, it's not, I'll be very honest, it's not like when you have a deed, it's not this old, brown scrolly thing with a stamp that says like, ye shall own the land. It's not, it's just a computer printout that says like your name and a bunch of legal numbers and stuff like that. So it's really anticlimactic in that way, but it's also very exciting because then you don't have to deal with a lawyer, you're just running in and getting the keys. Right?
I did tell Chris that I would pay him to do a scroll and that accent on closing for my clients because I think it's funny, but...
Yeah, I don't mind. Yeah, so really quickly on the day of closing, what happens, right? You've already given your lawyer the amount outstanding, so your down payment, land transfer tax, everything else. Then the mortgage funds get transferred into the lawyer's trust account, and we take that money and we pay the seller's lawyer,
we pay the land transfer taxes that are applicable, and then we basically release the deed, which is the transfer, to you guys, and the keys. And we just send a text or an email or a phone call and let you know where to pick up the keys. Quickly, next. Number one question that I get on the day of, close to the day of closing for buyers: when and where do I get the keys? Well, traditionally, before COVID, you would pick up the keys from the lawyer's office. They would mail, like physically mail the keys to my office, which was how old school lawyers operate. But now because of COVID, they've decided to smarten up and leave the keys either in a lockbox, or if you're in a condo with a concierge, or provide them to the realtors. Most of the time, it's never picked up at the lawyer's office now, especially after COVID. But in some occasions, you get people that aren't that bright and decide to still mail the keys over to your lawyer. Okay? Next slide, please. A couple of things I want to make sure that I'm very clear on in terms of my preferences is that on the day of closing, make sure you do not deposit your remaining down payment or balance of your purchase funds to your lawyer on the day of closing. Do it a day or two beforehand, because then you get some time just to make sure that the funds don't have any hold on them, or if there's any issues with depositing the funds into the trust account or getting the funds accessible. Also, don't book movers, contractors, internet service providers, nosy friends and family members to visit your property on the day of closing. Do it the next business day. The reason why I say that is because if you're planning on getting your keys at 3 p.m., if the seller's lawyer decides to go golfing that day and your property doesn't close until 6 p.m., you've just booked a moving van to sit outside in the driveway for 3 extra hours, right? So always make sure to book any kind of major moments of moving or improvements or anything the next business day, okay? And lastly, just real estate transactions take time between several parties, right? It's not just on your side. The sellers have to sign off on things and the seller's lawyer have to sign off on things. And I have genuinely seen some sellers' lawyers forget that they had a closing. So what would have eventually closed at 1 p.m. or 12 p.m. Closed right at the end of the day at 5:30. So that's why I always tell clients, don't expect to get your keys before 6 p.m. But other than that, it's, again, still an exciting day, but it's one of those things that you want to make sure you expect. So yeah, thanks guys.
Thank you.
Thank you so much. Thank you.